when you're starting out, you do not have the luxury that Blackstone or Bell Partners or one of
Yeah.
these big firms has to have a bad deal, because one out of 100 is not that big a deal. One out of one or two or three, and you're done, you know?
Yeah, that's true.
So it's way better to not do a good deal.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Mac Shelton. Mac is a co-founder of Sweetbay Capital, a real estate private equity firm focused on multifamily investments in Virginia and Carolinas, with 191 units under management as of now. Prior to Sweetbay, Mac worked in corporate private equity and private credit, where he closed nearly $5 billion worth of leverage buyouts and capital raises across various industries. Mac, welcome to Decoding Cashflow.
Thanks for having me on, Ted.
All right. So before we get started, Mac, if you'd like to give our listeners a little bit background about yourself and how did you get started into real estate?
Sure. So as you mentioned, I previously worked in corporate private equity and leveraged buyouts of companies as opposed to properties. I bought my first property right after school in 2017. It was a townhouse in Raleigh that I house hacked. I had two roommates and lived in one of the rooms. And then the first job that I got out of school, the company actually liquidated a year after I started. And I ended up getting a job in San Francisco. And that townhouse actually ended up covering about half of my exorbitant San Francisco rent. So that was sort of my first experience with real estate and really got me hooked. And I started looking for my next deal within a few months of buying the first one. I had no idea what I was doing, read as many books as I could find and listened to podcasts and made a lot of lowball offers that probably didn't make any sense. And eventually came across a student rental in Columbia, South Carolina that I bought in 2019. Ended up buying a few more of those, and my current business partner bought a few as well, and that led to Sweetbay's first deal, which we closed in 2021. The portfolio of those student rentals, we exited those about 15 months later, and that was kind of the launching point for us going full time and starting the business.
Awesome. So you started with student housing. Do you still own any student housing, or you totally?
I do. I own one. It's actually listed for sale right now. I really enjoyed student housing, and I think it's starting to get a little bit more popular than it was when we were buying it. There's definitely risks. Students don't take great care of properties, but as I'm sure neither do most tenants. So it's not, it's not really outside of the norm. And you do have more turnover, which can generate more risk in the sense that if you've got, for example, a brand new property that goes up across the street, your tenants are going to have an opportunity to move there next fall, if not sooner. Whereas in traditional multifamily, maybe they wouldn't. And at the same time, you get to that turnover also results in opportunities to grow rents faster in a lot of cases, right?
That's
because
right.
you're often putting new people in those units at least every 1 or 2 years. And you've got a guaranteed source of demand essentially with a college. So as long as you're in an area that is not seeing a ton of new supply and or you're near a school that's growing, there's consistent renter demand, and a lot of times you can get higher cap rates than in traditional multifamily as well.
Yeah, and these leases, they are guaranteed by their parents, so it's a very less
in a lot of cases,
chances
exactly.
of default.
That was really what got me into it. My first property, like I said, I rented a couple bedrooms out to guys my age at the time. I was like 22, and I saw how much more rent I was getting than people that rented their entire townhouse with an identical floor plan to a family, for example, because I was renting it out by the bedroom. And with student rentals, I got the benefit of that because I rented out a 5-bedroom house by the bedroom, but I also got the benefit of a parent in most cases with a good credit score and a good income, effectively guaranteeing the lease. So you kind of got to have your cake and eat it too.
Yeah. Oh, pros and cons everywhere, right? So Yeah. And what got you started in the multifamily, the regular multifamilies, commercial units?
Yeah, so we, after closing our first deal, our first syndicated deal, right, which was the Retreat Columbia, the portfolio of student rooms that I mentioned, we spent a few months looking for the same deal to rinse and repeat. That was a very unique situation with a seller that was not price focused. And we got it at a great price. It was 100% occupied, management in place. There are not many turnkey deals that offer the kind of returns that one did. And we realized that we weren't going to be able to generate those returns without either getting lucky again or doing some value add. We also, when we were looking for just student rentals, had to broaden our geographic scope more than we wanted to. And there was a point where we were looking at a deal in Louisiana, and I kind of realized, wait a minute, I've never even been to Louisiana. Why am I looking at buying real estate there when I live in the Carolinas? It's one of the best markets in the country to invest in. Let's just figure out a way to focus on places that we actually know. And the only way to do that and still have a pipeline was to broaden our scope from just student to also traditional. And because we knew we wanted to do value add, it's much easier to do value add when you have leases turning over throughout the year than when effectively all of your leases turn over in August, because you just don't have as much time to do renovations. You can't stage your rent growth rates to kind of see how the market responds like you can with traditional. So it just offers more flexibility and more deal flow.
Okay. And what are the main criteria you keep in mind while underwriting any properties?
I'd say the biggest kind of back of the envelope metric that we look at is yield on cost, pro forma stabilized yield on cost relative to an exit cap rate. Typically, we try to get at least 100 bips of spread between those two. The primary return metric that we look at is IRR, where that's how we get paid, right? Our promotes based on IRR, and we typically shoot for a 20% gross or deal level IRR, which translates to 14 to 16% net to the investors.
Yeah. Talking about the spread, are you still seeing the spread in the current market, or it's hard to find that spread?
I'm not seeing that spread. I've never seen that spread for the most part in our markets. I mean, we have seen it on the deals that we've closed and a few others, but you're not going to find that looking at Crexy unless you just get really, really lucky, right? You're going to have to build relationships with brokers, get access to off-market deal flow. A lot of the off-market deal flow is still going to be overpriced. And, you're going to have to find situations where you can offer something besides just the most cash in order to get the deal across the finish line. Most of the time there are, I'm sure, markets that do offer that kind of spread on sort of market deals, but they probably don't have the growth potential that the Carolinas and Virginia have.
Yeah, and there might be risk associated with that too, right? When you have a
absolutely
spread.
Yeah.
So of course you're right on spot. It's sometimes it all depends on your relationship with the broker, or if you are doing a direct mail or connecting directly with the owner of the property, that might lend you. Yeah. Right. Tell us about your first deal, the first multifamily. From sourcing, how did you find the deal? How did you underwrite it? How did you fund the deal?
Sure. So I'll start with Langdon and Briskwood. That was our first deal that really fits the current mold of what we're doing, which is value add, traditional multifamily. That was actually a portfolio of two properties, Langdon Square and Briskwood Place in Roanoke, Virginia. Total 41 units. We bought that in February of 2023, and we closed the first deal, the student deal, in October of 2021, and that kind of was a light bulb moment for us to realize how much equity that we could raise. And so that's really when we started looking for the next one. And it took us a few months, like I said.
So the first equity raise you did was for the student housing.
That's right.
Okay.
Yeah. I mean, it was a pretty small one. It was $300,000. So it was not a huge raise, but we could have raised probably 2 million or so within the first week. And that was a big realization to us, because we really had no idea how much equity we could raise until we tried. Right. So when we did get that deal closed, it gave us the confidence to look for more deals. And like I said, it took a few months for us to sort of realize that while we would still do student rental, we weren't going to be able to build a sustainable business focusing exclusively on student rentals. And we started getting serious about pursuing traditional multifamily with a value add opportunity, I'd say summer of 2022. Of course, our timing coincided perfectly with the Fed starting to raise interest rates, and the market has pretty much been frozen ever since. So
Right.
it was a tough first year. I mean, honestly, it's been a tough first 3 years, but at that point, we both still had W-2 jobs. We didn't have to find a deal, but we made a lot of offers and eventually came across landed in Briskwood. This was on Crexy. And I think the reason that we won the deal was we were able to get comfortable with higher rents than I think most other bidders were underwriting. I also think we were competing with less sophisticated bidders because it was one, it was a portfolio, and two, it was small. So most like nowadays we wouldn't buy a 15 unit property, and that one of those was 15 units, right? But we were just getting started, and it was a lot bigger than the first deal we did, so it made sense to us. So we found that one, I think around August or September 2022. Put in a bid, got under contract, and as far as underwriting, I mean, we started with single family, and then we did a portfolio of single family. Our model, our underwriting process kind of evolved along that vein, and we underwrite every unit effectively as if it's its own property, right? Like we have a rent schedule that turns over when the lease ends. There's a period of time that renovations occur, and then the rents go up to whatever we're underwriting as a pro forma. And we, like I said, got that one under contract, I think just before Thanksgiving of 2022, which was another complication because we went through both the holidays before getting it closed. But we actually were very fortunate with the timing that right around the same time we got an offer on the student rental portfolio, and we were able to 1031 the proceeds from the first deal along with all of our investors into the second one, and we raised another $1.5 million of equity to close that one out. I think the deal's closed. I think the exit closed 2 or 3 weeks before the acquisition, so the timing really couldn't have been better for the 1031.
What was the price, the total price for that buy?
So we paid $3.25 million.
Okay.
Yep.
For 41 units, right?
Right.
That's pretty good. All right. Any any tough experience or any headaches you ran into while doing your first deal?
Always, right? I mean, it's been a while now. I'm trying to remember that one, and actually, it was easier than the last deal we closed. The loan was probably the most difficult part, as it oftentimes is. Yeah. There weren't really any surprises in diligence on that one. Well, besides the financing. So the broker that took it out to market took it out with effectively a staple for financing. They talked to a bank, and they had a term sheet that kind of went along with the OM, and everybody was bidding using that term sheet because it was, I think the initial terms were 5.65% interest rate, which now is really good. Back then it was probably 50 to 75 bips lower than kind of prevailing market rates. And we bid based on that. It was supposed to be 2.3 million of debt at closing at 5.65. I think it was maybe the week before due diligence ended, that the lender came back and said, sorry, but we're out. Not like we're changing the terms, but we're passing the deal. We were like, what the hell are you talking about? Like, it's too late for that, And it was something stupid. I mean, it was basically one of the properties is in an area called Old Southwest, which is an awesome old neighborhood right in downtown Roanoke. It's historic. There's 150-year-old houses that have been well maintained and restored. But there's kind of two sections of it, and the northern side of it used to be rougher. It's really not anymore, but 10 years ago it was. This isn't even in the north side; it's on the south side of Old Southwest. And basically, the location they weren't comfortable with. We pretty much called the broker and said, you brought us this loan, go fix it. And he basically called the CEO of the bank and said, if you ever want to do another deal with Cushman, you're going to figure this out. And they did. But instead of 2.3 million at closing at 5.65%, it was 1.8 million at closing at 6.35% with a $500,000 credit line. So we did have to adjust the price a little bit to account for that. But it was, I think we took $250,000 off of a $3.5 million purchase price. So it was, less than 10%. And considering that everybody else who had bid less than us was also counting on that term sheet, I think the seller understood that if they went back out to market, the financing had changed and all the offers were going to be lower anyway. So we got it closed, and it's gone really well. I mean, we tripled NOI in the first year. Within a couple months of closing, it became very apparent that we were probably our underwritten target rents were probably $100 below what was achievable. And in a lot of cases, we were beating our target rents without even renovating units. We had, people that were renewing at the rents we'd underwritten as our post-renovation rents. And we realized that we didn't need to spend nearly as much as we'd underwritten on renovation. So I think we had budgeted. One of the properties is bigger. It's 26 units. The other one's 15. The 26 unit has 2 and 3 bedroom floor plans that are mostly 1,000 square feet or bigger. And so I think we'd underwritten 15 or 16,000 a unit for those. And we had one where the tenant broke his lease and left right before closing, which actually worked out well for us because we got a closing credit that was like 2.5 months worth of his rent, and we had it filled up in 2 weeks. But because we had this vacant unit at closing, we're like, all right, well, let's just experiment, not do the full money on the renovation, and just do flooring, paint, appliances, and lighting. I think it was $6,000 or $7,000, and let's just see if we can get our target rents doing that. We had at least in like a week, right? So we're like, oh, okay, we don't need to spend nearly as much money. We've actually given a lot of our renovation reserves back to our investors since then, and we're well ahead now of our target rents.
Yeah. So the loan terms and condition change at the last moment. How did you account for that? Like, you had investors' money sitting in your account, and now the terms changed. You had to put more down. Did you had any buffer already in place, or you had to raise more money after that?
So on that one, we actually didn't start marketing the deal for equity until after due diligence. Our thought process was, if we send the deck out now, we haven't done, first of all, we didn't know what the hell we were doing, right? We had never done it. We'd done syndications, we'd done real estate investments, we'd never done renovations. So we really didn't know what we were going to find out in diligence. And these were older than anything we bought before. So we were like, all right, let's wait until we have done at least the unit walks and updated our model, and we knew we were going to have to adjust the price. Let's wait till we do that, so that when we send out our offering memo to investors, it's accurate, right? And we're just changing a couple little things here and there between now and closing instead of rewriting the entire deal. In hindsight, it worked out fine. Fortunately, we will probably never do that again. Now we typically send our OMs out when we sign the PSA, and we try to have our equity all committed by the end of due diligence, so that if for any reason we can't raise the equity, we're not on the hook for the earnest money. Fortunately, we've been oversubscribed on everything so far, but I'm sure one of these days it'll happen. And so we did not have to raise more equity, but we did have to adjust the price.
Okay. Now moving on to the investors' relationship, right? At the initial stage, how did you build up your investors' database? Like, what were your main strategies?
Yeah, so I had been trying to pull off something like our first deal for a few years prior on a smaller scale. I talked to a handful of people that are current investors of ours about, putting $100,000 into some little deal that I was looking at that I didn't have enough money to do myself here and there. And we had actually, so my partner and I, the last 2 properties in that student housing development that we bought as personal investments, we bought from the same seller group. And I didn't know this until that deal, but there's this program, I think it's called ED5, where if you own enough real estate in the US as a foreign national, you can get expedited citizenship. So basically it was a syndicate of Chinese investors managed by a guy out of Singapore that had bought, I think 11 or 12 of these units, 10 years ago. And it was just a nightmare to deal with because one, the investors didn't speak English. The guy that managed the investments for them was on a 12-hour different time than we were and wasn't very responsive. And, it was right after COVID. The attorney for the sellers actually got COVID right before closing and was out for like a week and a half. So, it was just a nightmare process. And we got those deals closed, and Tucker, my partner, called me and he's like, hey, nobody else is going to want to deal with these people. We should buy the rest of these. And I was like, Yeah, you're right. I mean, I didn't want to, but he was right because, we'd done it. We knew we could do it, and we probably could get some, advantageous pricing because we had done that already. So we got the plumbing in place to do something like our first syndication when we tried to go after the rest of those properties. And we bought all those properties from the same broker. So he kind of knew what we were doing. We'd already kind of agreed on an economic arrangement with him. It ended up falling through because not all the sellers wanted to sell. The manager just didn't want to manage it anymore, and he wanted them to sell, but they didn't. So that one didn't happen. But then 3 or 4 months later, the guys that built the development called our broker and were like, "Hey, we want to get rid of the last 11 units we own down there. Do you know anybody that can take them all down?" And he was like, "Well, yeah, I just tried to do the same thing with, I think it was 9 or 10 units with these guys that already own a bunch of stuff down there." So, he called us. There was no other bidder. We got it under contract, within a couple days, and that it was kind of up to the races at that point. And it was an easy diligence and an easy fundraise because we'd already done our business plan. I mean, it wasn't even much of a business plan, right? Because it was turnkey, but we'd already done it 5 times successfully with personal investments down there. And we could show investors like, look, I bought this property 2 years ago and it's doing 15% cash on cash yield every year, so it just made it a lot simpler and easier than, going into a new market or even in a market, buying something that's different than what you've already owned.
So basically you started with the people right? Friends, family, the people from the previous, interaction.
Right. So it was that. And then it was, like I mentioned in the beginning, both my co-founder and I spent our careers prior to this mostly in investment banking, private equity, private credit. And you get to know a lot of old rich guys doing that. And that turns out to be very valuable when you go into a business like this. We've got investors that were C-suite executives at some of the companies that we bought or tried to buy during our time in private equity. We have senior leadership of the firms that we work for that invested with us. We have not so senior leadership of the firms we work for. So it was a combination of people that we had already talked to about, deals in the past, and just people in our network that knew us. They'd seen us work on bigger, more complicated transactions in the M&A world. And, it helped that we had, like on the first deal, it helped that we'd already basically done it, like I mentioned, right, with the personal investments. And then on the second deal, it helped that we could say, hey, our first deal is under contract to sell at a 77% IRR, right? So that made it easier to raise the money for the second one as well, because it was like, yeah, we've never really done value add multifamily before, but we've done multifamily and we knocked it out of the park. So that I think helped a lot with the fundraise.
Was
and
it
just the experience of, doing large M&A deals. The first sort of, the first job I had, like I said, they sold a year later and I didn't really get a lot of reps, but the first kind of real job that I had in private equity was on the capital market side. And my team was responsible for essentially financing all of the deals for a multi-billion-dollar private equity firm. And so and Tucker had done the same thing with investment committee memos. Like I had put together a lot of pitch decks to convince insurance companies and, big LPs to write, 100 million plus checks. Tucker had put together a lot of decks for investment committee to convince a bunch of partners to commit a lot of money to deals. So I think the detail, the granularity, and the just sort of polished nature of the decks that we've put together is a differentiator for us relative to some of the stuff I've seen. I've seen decks that are way better than ours. I've seen more that are, 10 pages long, and most of it's the market slides from the broker's OM. So I think when people see that, it's like, okay, these guys at least have a handle on them,
So you leverage the past experience, whatever you had in the private equity sector. Yeah.
Yep.
And was this deal a 501, 506C or B?
All of ours so far have been B. So we may do a C at some point. I mean, the reason we haven't is just it's more compliance paperwork and all that kind of stuff, and we haven't needed to. So we've just done 506B so far. But
yeah, as long as you are able to raise the required equities, it doesn't matter,
exactly.
right?
Right.
That's great. Right. Have you done have you Have you gone full cycle on any of these multifamily deals or not yet?
Well, I mean, there's the first one, the student rental was full cycle,
Oh.
but so far none of the other ones have. I mean, the oldest one is 14 months old,
Oh yeah.
so
So
we're
of
not
course you're gonna
even,
hold on to it
but
for a
yeah,
few years
I mean,
before.
we typically underwrite to either a 4 or a 5 year hold.
Okay.
And, we market it to investors. We say it's 3 to 7 years because we'd love to sell earlier in most cases if we can do it without, diluting returns, because again, we're IRR driven and selling sooner helps IRR. But we actually are getting ready to list one of our properties, the smallest one, Bristol, right now, which has been a great performer for us. I mean, it's that's the one I mentioned. It's in Old Southwest. It's walking distance to everything in downtown Roanoke, and the finish levels. We actually just experimented with kind of a higher end renovation there. That's basically the renovation we had originally planned on doing, right, and budgeted for. And we're able to push rents an additional $100 above where we've been previously, which we did to prove that out to the next buyer. And I think we've got it leased now. So I think that hopefully that strategy works and somebody sees the opportunity there.
Yep.
That will be our first full cycle kind of value add multifamily.
Value add multi. Yeah, that's great, man. So now let's switch the gears and move on to what do you think about the current market situation? What's your take on it? With the interest rate this high, are you able to see good deals flowing in? Are you able to underwrite anything?
I mean, we underwrite a lot of things. Most of them don't pencil, and we've kind of been of the view, even before March of 2022. It's one of the things that's been interesting to me about transitioning from corporate private equity to real estate, syndications, basically, is like there are brilliant people in both camps and there are not so brilliant people in both camps. I think in order to get a job in corporate private equity, you have to have sort of a baseline understanding of finance and economics that isn't always present in real estate syndications. And when you see interest, I think the prevailing interest rates at the time, right before they started hiking, were 2 or 3%, and inflation was 8%. And when that's happened historically, rates have gone up. I mean, that's just kind of textbook, right? And it was this big surprise to everybody. But we've been of the opinion for quite a while that rates were going to come up, and as a result, we've been underwriting, I think, higher exit caps than a lot of buyers for a long time. And that's a big part of why we've only done 4 deals in almost 4 years, right? But we'd much rather do a deal a year that actually pencils with conservative underwriting and makes sense and that we're not worried about than stretch and get aggressive and buy something we shouldn't have because we're trying to get a deal done. And that's one thing we've been intentional about with the company too. I mean, it's still just the two of us. We would love to hire somebody because we're really trying to do more than 2 people can do well. But when you start hiring people and adding overhead, you can get yourself in a situation where you have to choose between doing a mediocre deal to fund your payroll or running out of cash, and we never want to be in that situation. So until we get to a point where we feel very comfortable that we have enough recurring revenue and cash saved up that we can fund things out of pocket for at least a year or 2 or 3, we're just not going to add overhead that would put stress on us in the business that might lead to bad decisions.
100% agree with you. See, the deal, as long as it's all about the number game, right? As long as the deal pencils out, if you're getting the right cash flow IRR, it doesn't matter what the interest rates are. And you rightly said, right? There are many operators I've seen, who have expanded too fast, and just to run the payroll, keep the employees, they'll go for mediocre deals just to get some fees and make sure the cycle keeps running. And of course that doesn't help in the long run, as you mentioned, right?
I mean, it's worked out for so long, right? That's the challenging part, and it's it's part of part of the reason that we're as conservative as we are too is, like I said, right, we have some experience buying personal real estate before this and doing some syndications, but most of our professional experience is buying something besides real estate. And
Yeah.
we really try to be very self-aware about what we don't know and build enough cushion to account for those things into our underwriting, And
Yeah.
as we, we don't need to build in as much just generic cushion on your second deal as your first deal, because especially if it's in the same market, right? A little bit more, and you have a better feel for what rents are going to be. You kind of know what to check earlier in the process, so you have tighter numbers starting out. But a lot of it comes down to that too.
Yeah. So, Mac, what would be your suggestion to anyone who wants to get started in multifamily? How can they get started? What are the steps that you would suggest them?
So I think, read everything you get your hands on is a good one, right? Try to, I think, you can certainly go straight into multifamily. People have done it successfully. That's not how we did it. We started with single family rentals, where the worst thing that could happen is we could lose our own money, and it wasn't a lot of it,
Yeah.
And I don't know, because you can't really go back and test this theory, but I suspect we would not have been as successful with fundraising the first deal had we not done some real estate deals on our own before and had success with it, right? So I would say, try to buy, do a house hack, buy a small duplex, do something that you can do either by yourself or with one or two partners that, doesn't necessarily have to be on a website track record for everybody to see, and learn what you're doing, that way. And then I think one of the biggest things that's been helpful to us is, like, don't be afraid to just reach out to people that have done what you're trying to do, and network relentlessly. Don't waste the connections that you make. Keep up with them. We have investors that, I've tried to keep up with people from high school and college that I didn't ever really know when it was going to, turn into anything, but it's never a bad idea to have connections that have access to capital and resources and knowledge that you don't. And you just got to build as many of those as you can and maintain them, because, eventually they may be your investors, your clients, they might buy a deal from you, they might sell a deal to you. It's just, you got to be tied into people that are doing what you're trying to do,
Rightly said. I also believe in the same thing, network, because network is your net worth at the end of the day. That's going to help you build whatever you're trying to do.
Right. And take advantage of it while you're young too. That's one big thing. I think that, it kind of is what it is. I think the older you get, the less people kind of care to help you out. You know what I mean? And when you're 22 and you're talking to somebody who's 60, they're like, oh, it's kind of cool that this kid's like trying to do this. Let me see if I can help them out.
Mm-hmm.
When you're, 50 and talking to somebody who's 50, they're like, it's just, and still a lot of people still want to help you, but it's just not the same. You know what I mean? So really take advantage of it when you're young, because one, if you say something stupid, nobody's really going to hold it against you like they might if they expected more, because you're older and more experienced. And two, you're just going to have a more diverse exposure to different people. I think when you're younger, and you're probably, you probably are switching jobs, you probably just got out of college, whatever. You have more different avenues to meet more people.
Yeah. All right, Mac. I'm loving this conversation, but want to be mindful of your time also. So we'll switch the gears to the final round of questions. Are you ready?
Sure. Yeah.
All right. So to start with, which is the one book that you'll recommend to our listeners, which had the most impact on your life or on your business?
I'd say on our business, the book that probably had the most impact was the Best Ever Real Estate Investing Advice book from Joe Fairless. I don't know if I got the name right. Everything's Best Ever branded with him, but and there's other books like it, I'm sure, that, and we've read some of them, that lay out a playbook for kind of start to finish, like how to get into this game and do it well. And my co-founder and I both read that the summer of 2022. We sort of decided we wanted to get into this, and it did. We didn't do everything the book said, and we did some things the book didn't say, but we kind of had at least a an explanation of, one way to do it. And
Yeah.
there are things we probably wouldn't have thought of without that book. So it's a good
Mhm.
sort of 101 playbook for how to do this successfully.
Yeah, good start point. Yes,
Exactly.
I've gone through that book also. Yep, it's a good book. Yep. What are your main source of information to learn and grow?
Networking. I mean, that's the number one thing, right? One example I can give is there's a company that actually the private equity firm used to work for acquired after we left that does repiping for, commercial and multifamily, lots of different buildings. And we got connected with them through the private equity firm and learned more in 2 hours on the phone with one of those guys about plumbing than we could have learned in 2 months on the internet, So, that's just one example. I mean, there's tons of them. That first deal that we held for 15 months and had a great outcome on, we underwrote for 10 years. And we talked to another syndicator who's 5 or 6 years ahead of us in terms of, their business. And when we told them that we had under a 10-year hold period, he's like, why the hell would you do that? It's your first deal. It's small. You're not going to want to spend the time managing this in 1 year when you're doing bigger deals, much less 10 years from now. And you're never going to be able to build a track record of full cycle deals if they all take you 10 years, And it was like, there's certainly a time for longer term holds, and we're trying to figure out better ways to make that work with our business model. But he was right. At the end of the day, when you're starting out and you're trying to build a net worth and you're trying to build a track record, you need to turn deals around and exit. And like I said, I think if we hadn't had that exit, I'm not sure we would have been able to raise the money we had for the other deals. So yeah, I think the biggest is just talking to other people that have been there, done that.
Awesome, man. What is the best advice, investment or business advice you'd like to give out to our listeners?
I hate to repeat myself, but it's probably still networking.
Still
I think.
Okay.
I mean, if you want to be specific around what we do, if I had to boil down our entire philosophy into kind of one principle, at least so far with Sweetbay, it's been, we're in the business of building a track record. We're not doing deals big enough to make life-changing amounts of money for us right now. And I mean, the first deal we charged an acquisition fee and that was it, right? And it was like 3% and there was no promote and we hardly made any money on it. But the deals we were able to do because of that outcome and the fact that we now have a full cycle deal, which most sponsors that are 2 or 3 years into this don't have, is not even quantifiable. So just focusing on building a track record and what that kind of translates into is when you're starting out, you do not have the luxury that Blackstone or Bell Partners or one of these big firms has to have a bad deal, because 1 out of 100 is not that big a deal. 1 out of 1 or 2 or 3 and you're done,
Yeah, that's
so
true.
it's way better to not do a good deal than it is to do a bad deal.
That's true. Yep. All right. The final questions, Mac. How can Decoding Cashflow listeners get in touch with you?
So you can visit our website. It's www.sweetbay-capital.com. We're on LinkedIn. Sweetbay Capital is the name of the page. I'm on LinkedIn, Mac Shelton. And that's probably the best ways to get in touch with us. All
right, Mac. It was a pleasure talking to you. Thanks for taking out time and being on the podcast.
Yeah, likewise. Thanks a lot for having me.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.